should you set up your dividend portfolio with ETFs or with like 50 other individual company stocks? This is a great question, and it came from Jason Ramirez. And I'm super excited to go over this one today on office hours. Remember, this segment is unedited. It's just between you and me, the same way that if somebody from one of my classes decided to want to go deeper on an assignment or on the lecture, they would come to office hours and ask an actual question. So if you have a question during this segment, please put it down in the comments and maybe I'll pick yours next week. All right, so this is just such a solid question, and I get this question all the time, and I even think about it myself. Because at the end of the day, the question kind of comes from understanding diversification, right? I think that we all understand that if you just have one stock and that's your whole portfolio, if that thing goes up, that's awesome. But there's so many things that could go wrong, and so if that goes down, you lose money, and that is not cool. Should we have a portfolio that's full of ETFs that are very diversified, obviously, but then also the dividend tends to be just a little bit lower than the opportunity that if you have a whole bunch of company stocks, some of those are up in the 5, 6, 7% range. So maybe those might be better to go with. And if you truly understand diversification, then maybe just picking 40 or 50 company stocks and making sure that they're diversified could do the same thing. So let's talk about it. I have a couple of options for you, and it really depends on the type of person you are. But then by the end of the video, I'm going to tell you what I do personally and how my portfolio has evolved. So first and foremost, I would recommend for anybody who's starting out, if this is your first portfolio, if you have just a little bit of money, I always recommend ETFs. Very, very solid for beginners, but honestly, somebody could just invest in 1 to 3 ETFs, and that be their only investment for life. And by doing so, you're going to get diversification, which means that your risk stays pretty low. It doesn't mean no risk. It just means that it's pretty low because of all the different companies. For those of you that don't know what an ETF is, very, very quickly, an ETF is just basically like a group of stocks. So like, for example, if you're investing in VYM, which is the S&P 500, you're investing in basically 500 companies, just a small piece of each one when you invest in that one ETF. But as I said before, smaller dividend, of course. So as a beginner, or as somebody who just wants to have very, very low stress in their life, ETFs is just the way to go because you don't have to worry about it. You don't have to do a bunch of research. You could just set it and forget it, and every month put like $100, $200 in there, and by the time you're at retirement age or something of that nature, you're making a good amount of money from dividends because you just have a big nest egg. The other way to do it would be to have those multiple companies, individual company stocks. Now, this is for those of you that are a little bit further along. Maybe you've already invested in ETFs, and so you kind of understand how the investing works. What I'd recommend here is looking at the different companies and looking at actually researching and deeply understanding what each company does. Definitely, definitely, definitely do not start with the highest dividend yield. There's going to be some out there that are like 20% or something. And if you look long enough, you're going to see that companies can't sustain that. And so your whole idea with dividend investing is to hold long term so that you're getting a dividend every single quarter for the rest of your life. So you want a sustainable company. And so lists that I would look at for you at first would be the Dividend Kings and Dividend Aristocrats. These are companies that have a track record of consecutive dividend growth, basically, every single year. And that's what you want to be looking for, especially at first. Now, yes, some of them have higher dividend yields like Verizon or AT&T, and those ones are solid companies. They're not going out of business anytime soon, but you definitely want to see like what is their competitive advantage, how is their company structured, how many years have they had a dividend and had dividend increases, what's their cash on hand, how are they paying down debt, all of that kind of stuff. And so obviously with all those things that I just explained, it does take research, it does take time, and so that is the negative, I'd guess, just for investing in individual companies. But if you are into that, if that's something that you have a little bit of time to be able to do and you can keep up with that, then I definitely say go for it. But remember, we don't want to be looking for just the highest yield company. And so for me personally, what I did and what I continue to do is about 70% of my portfolio, maybe even closer to 80%, is those ETFs. It's just so easy, it's so simple, the data's on our side. Good solid ETFs with low fees, things like VU, SCHD, QQQ, VUG, VTI. There's just so many good ETFs out there now. The problem is that it is kind of boring just investing money into those, but I tell people making money isn't that boring though, right? Losing money isn't boring either, and we don't really want to have that kind of excitement. So I'll pick boring all day, especially if it's making me money. But I do, especially as a business professor, I do like to invest in certain companies that I really, really like, and I like what they're doing, things like Apple and Microsoft, Berkshire Hathaway. I've always liked Disney, but Disney is going through some things right now, but I still believe in them as a company. And so things like that. And I'm always looking at different companies for different things and for different reasons. And you can see that in a lot of my videos that are not the office hour style. But anyway, what I'd recommend is first build up that portfolio with a good solid base of ETFs, and then use a smaller portion for the higher risk but higher reward companies. So that's the way that I do it. I would love to hear the way that you do it, and remember to put down in the comments section some questions so that I can answer it next week. See you on the next one.